So in terms of bubbles, I think you're seeing selectively bubbles everywhere. The key question of whether or not you're going to have we're going to have a correction at some stage. Typically, corrections of 10 to 15% are quite normal, and investors have to be prepared for when that happens. When does it happen? Well, Bank of America have been calling that literally for the last year, so they're still calling it, but it hasn't happened. One day they'll be right. Generally speaking, the investors that do best are not the ones waiting for that big crash, because they never become invested and they never make any money. And you can, in the same way that you can get drawn into an irrational exuberance, being overly fearful is not going to get you anywhere. And it again goes back to the thing that the system will perpetuate itself over time, and governments are committed to sustaining these very, I suppose, mature economies. And for all investors, they need to be aware that we've seen these bubbles that many times before. It's not a new phenomenon. It's just always a little bit different, so that people confuse new with different. And it will be a case of when you do have a drawdown, there will be a shakeout of some of these new investors that are either too leveraged, too many margin loans, or too many option plays that don't work out, and they will probably get their fingers burnt. But sometimes that needs to happen so everybody has a reality check. And it is still the one reason I say I go to invest in the US. It's for innovation and technology. So the premise of this book is that I felt like, oh, wow, suddenly the world of technology and innovation allows for everybody in Australia to gain exposure to the US stock markets. I would like to share why I think that's a really, really good idea.
Welcome to the Get Invested podcast, where we share great conversations with experts from all walks of life to uncover their secret know-how and where they invest their time, their skills and their money, and the benefits that this has created. You see, the truth is that everyone invests. Every minute of every day, we're investing our time, our skills, our energy and our money in something. Some of us are investing consciously, some unconsciously, sometimes for good, sometimes for bad, sometimes for no impact. Get Invested will help you to start living by design, not by default. I'm going to help you to make it happen, not let it happen. You will hear the top tips on how you can live with conscious intent so that you can live more, work less, and leave a living legacy by investing now. Listen to the show to discover the top tips on how to get started, make the most of your investment journey, and ultimately to be living your dream, not someone else's. More episodes can be found on iTunes or at bushymartin.com.au/get invested. Thanks for listening, and now let's get invested.
Hi, Freight Inviters. Are you actively investing at the moment or sitting on the sidelines and waiting because of all the uncertainty that surrounds us? And if you're investing, what are you investing in and where? Are you invested in shares and equities, either directly or through index funds, exchange-traded funds, commonly known as ETFs, or managed funds? And if so, do you have any exposure to the US stock market? Why would I ask you this? Because we live in a time of incredible technological change, innovation and disruption, which has been greatly accelerated by the pandemic. And with massive change comes massive opportunity. But you've got to be in it to win it. And the reality is that most of the big innovative companies riding the wave of change that will shape the future are all based in the US. As evidence of this, since the advent of COVID, and after a brief sharp drawdown, equities markets have gone ballistic around the world, especially in the good old US of A, with the S&P 500 index jumping to record highs and investors putting more money into shares in the last 12 months than the last 12 years combined. And this has happened alongside a massive increase in the number of new and active investors in Australia, reaching a record high of 1.25 million, a 35% jump over the year, with over 435,000 Aussies placing their first share trade in the past 12 months. And with the American market cap representing over 60% of the global equities pie, it's a market that you can't afford to ignore. But you need to be very careful about how you do it, particularly when irrational exuberance and FOMO are driving investors. Now, I can hear you say, yeah, that's all really good, Bushy, but there's been way too much talk about bubbles and bursts, so I'll just sit it out and wait until after the crash, and then I'll get in. Well, let's start by putting the boom, bust and crash scenarios to the test by drawing on the excellent recent insights of Raman Ecuyer from PensionCraft, who appeared on Get Invested back in episode 165. So if you hadn't had a listen to it, make sure you jump in and do that. Because I can understand your reticence to get invested in the stock market, and particularly the US stock market at the moment, given the large number of investment gurus who've been loudly forecasting impending doom. As an example, Michael J. Burry, the US investor made famous in the Big Short movie, has recently forecast that we're going to see the mother of all crashes. Now, many people listen to what he says because he correctly called the dot-com bubble in 2001, and famously he forecast the US mortgage foreclosure crisis of 2007 that led to the global financial crisis. But is he right again this time? Well, let's put it to the test based on leading analyst Raman Ekuyer's assessment. In a recent tweet, Michael J. Burry says that there's lots of hype and speculation that's drawing in lots of retail investors, who are normal investors like you and I, just before the mother of all crashes. And he describes the rally in some of these stocks as what he calls a FOMO parabola, which is a fear of missing out trade, where people see markets moving up and they're drawn into the market just before a crash. And of course, the parabola is one of these exponential increases in share prices that we've seen for some time, especially in some of these meme stocks recently, like GameStop and BlackBerry. And his point is that these exponential rises, these FOMO parabolas, don't resolve sideways, which is his way of saying there's going to be a big crash. Now, Burry contends that contagion from dramatic falls in the crypto market and the meme stock market will spread into the broader share market. Burry believes that when crypto falls sharply or meme stocks fall sharply, this will spread to the broad market. And that way, major stock markets are going to lose huge amounts of money. And the analogy he uses draws on parallels with what happened in 2007, when a tiny market, which was a subprime housing market in the US, spread volatility throughout global financial markets. And in fact, there was almost no market that was unscathed by that sell-off. And his point is that history hasn't changed, and that we're going to see a widespread sell-off triggered by sell-offs in these smaller markets. He also tweeted that the problem with crypto, as in most things, is the level of leverage, or the amount that many investors have borrowed to secure the cryptocurrency. And it's not just cryptocurrency which has its own leverage problems, but equity markets may suffer from this as well. So let's dig into the cryptocurrency story, focusing on the popular Bitcoin, which captures most of the attention. And we've certainly seen a big sell-off in cryptocurrency this year, dropping in value from its high in mid-April 2021 by over 45% in mid-June, and recovering somewhat now, to be down by roughly 20% from its peak at the time of this recording. Now, this has been mostly due to a succession of negative news stories, such as a story in the Financial Times about China cracking down on cryptocurrency mining. So it certainly appears true that there's been a significant crypto correction. Now let's look at meme stocks. Meme stocks are shares of companies that have seen a recent surge in viral activity, which is usually fueled by online social media platforms such as Reddit and Twitter. The buzz over a particular stock prompts mum and dad and first-time speculators to buy the stock with the knowledge that its share price is likely to rise. Now, while it's certainly been a rough ride for many meme stocks, the one which has been faring the worst, BlackBerry, is still up over 80% since the beginning of 2020. So meme stocks certainly don't appear to have sold off yet. But the key question, based on Michael Burry's prediction, is whether the sell-off in these relatively small crypto and meme stock markets will affect the much broader US S&P 500 stock market, which really could make the rest of us poor. So, taking a look at how the S&P 500 is holding up, the cryptocurrency peak in April-May and its subsequent 20 to 45% sell down hasn't had any impact on the S&P 500, which continues to rise, achieving continued growth of 6 to 8% since mid-April. And the cryptocurrency market is much bigger in terms of market capitalisation than the tiny meme stocks. So it appears very unlikely that the tail could wag the dog, and those tiny markets could actually drag the S&P 500 down. If the S&P 500 does crash, it's likely to be for other reasons which will trigger the sell-off. But as I've said on countless occasions in the past, I think it's unhelpful trying to time these market crashes. As Rahman Akisa says, Michael J. Burry may say he knows when it's going to happen and what the trigger will be, but he doesn't. Just because he's timed those market sell-offs in the past doesn't mean he has some special insight. But where Michael J. Burry does have some really interesting things to say is around leverage, or the amount of borrowed money that investors put into their investments, because that, after all, was what triggered many of the big sell-offs in the past. So let's see what the fundamental problem is with leverage into stock markets, and where we currently stand with the level of leverage at the moment, and to understand leverage and its role in market movements. Now, it's good to understand leverage or margin, because this is the amount of money which a customer deposits with a broker when they want to borrow money to invest money. And the reason why they do that is to amplify their returns. But the two-edged sword problem is that it amplifies not just the positive returns, but also the negative returns. To see an analogy with the current market rally, let's look back to markets in the run-up to the global financial crisis in 2007. Over the 4-year period in the run-up to 2007, US equity markets were very strong and were experiencing a huge rally of about 9.5% per year, which investors were extrapolating forward and, understandably, getting very excited about. This is called recency bias, whereby if we've had a recent rally, we think that it's going to continue into the future. Now, the longer a rally lasts, the more people get convinced that it's going to continue. And that means that people tend to take more risks towards the end of these rallies. So if market returns have been just under 10% for the last 4 years, why not amplify your returns through leverage? Now, for many investors, this is very easy to do. You just borrow money from your broker and invest that borrowed money, and that amplifies your returns by up to 10 times. So let's say we have $10,000 to invest, but we actually want to invest $100,000. How do we do that? Well, we could borrow $90,000 from our broker or bank. Our total investment exposure would now be worth $100,000, with just $10,000 of our own money down. Now, after a market rally, it's often the case that markets correct very sharply. And of course, that's exactly what happened in 2008, when there was a very sharp fall in US equity markets triggered by the subprime market meltdown. And if we look at the effect on our $100,000 investment, it would have fallen very sharply to just over $44,000. Now, we borrowed $90,000, but of course we've still got to pay that back. And once we do repay our $90,000, we'd end up underwater in the red by $46,000. In other words, we'd have lost over 4 times our initial investment. And certainly for some people, this would create financial ruin. This is the dark side of leverage with shares, which multiplies our losses as well as our gains. So in this case, we'd have taken a 56% loss if we'd just invested our $10,000. But with leverage, we've turned it into a 560% loss. So is it really the case that people get more leverage margin towards the end of a rally than they do at the beginning? Well, based on Rahman Akisa's research, one of the US regulatory bodies called FINRA collates information from all of the brokers in the United States on how much leverage their customers have. And this stretches back to way before the year 2000. Now, FINRA's data shows that during the current post-pandemic rally, the amount of leverage has increased hugely, and it's now standing at over $862 billion US. And the peaks in FINRA's margin figures tend to happen just before a market peak, which was demonstrated in the year 2000, which was the height of the dot-com bubble, as well as a significant acceleration in the amount of margin debt just before the global financial crisis. So acceleration in the growth of leverage came just before the dot-com bubble burst, and in the aftermath of that dot-com bubble bursting, equity markets in the US took a huge tumble with a peak-to-trough loss of around 45%. And a huge amount of deleveraging took place while those equity markets fell. And then the same thing happened again during the global financial crisis, with an acceleration in the amount of leverage and a very significant fall in equities markets by around 50%. People lost half their money. So in this aspect, Michael J. Burry is on the money in that leverage is often a problem when it comes to market sell-offs, and particularly worrying in this acceleration that we've seen in leverage through the current pandemania bubble. If it's anything like the previous two crises, then we could be about to see a significant sell-off. But wait, before you run off and sell all of your shares or continue to sit on your hands, this is certainly not a foregone conclusion. Just because we've had two previous episodes where US and other global equities markets sold off after this acceleration in leverage doesn't mean that it's definitely going to happen again. And remember, we've only considered two data points here. There were also smaller accelerations in leverage around 2010 and around 2013, but we didn't have market crashes at those times. In fact, equities markets did just fine, so don't be convinced by just one number that equities markets are going to crash. There is no perfect predictor for equities markets. Nobody knows over the short term what's going to happen. Not Michael J. Burry, not Rahman Nakisa, definitely not me, and most likely not you either. And even though we have huge experience of profits being unreliable, we're still desperate for people to tell us what the future holds. I get asked to do this all the time. What's your forecast for the housing market, Bushy? For the share market? Well, on the equities markets, I avoid this like the plague. And that's because it's just not helpful. You can't really forecast markets over the short term as there are too many dynamics at play. As Rahman Nakisa says, what you can forecast more accurately is what equity markets do over decades, because there, the gradual increase in earnings drives equity markets higher, and over longer periods of time, equity markets become much more predictable. So if somebody gives you one of these short-term forecasts, don't believe them. Nobody can make reliable forecasts over a period of around 5 years or less. Now, the author of the great book, The Psychology of Money, Morgan Housel, says that everything is sales. So when somebody makes a forecast, think, why are they saying it? So Michael J. Burry says markets are going to crash. Is that because he's got a short position on the S&P 500, which means that he's placed a trade that bets on and profits from the market going down? If that's the case, then he's probably trying to trigger a market sell-off, which will work in his favour. In investment, this is called talking your book. And it might be the case that in Michael J. Burry saying that there's going to be the mother of all crashes, he's hoping that that's going to be the case once he's made that prediction. And with high-profile investment commentators like him, this type of market signalling can become self-fulfilling prophecies when investors start acting on his fear-mongering. So I'd be wary of these prophecies because it might just be somebody trying to move markets in their favour. Now, it's inevitable that with some segments of stock markets trading at very high valuations, there's going to be a correction. But no one knows when or how dramatic this is going to be. As investing is a game of finance where access to money and credit tends to drive demand, I'd be looking out for warning signs of a combination of when the central banks stop printing money via bond purchases, when macro-prudential measures start squeezing the ability to borrow money, and when there's a move to raise interest rates. But none of this is intended as financial advice in any way, shape or form. And I recommend that you seek independent professional advice based on your specific financial situation and your risk profile before taking any action. And of course, if markets do crash, that's great, because it means that equities are on sale. Just remember that crashes, corrections and market drawdowns are not a time to sell, but a great time to buy. And it's actually a feature of equities markets that periodically we do have these sales. But what I can guarantee is that nobody knows when those crashes are going to happen. What I can also guarantee is that if you intend to be a successful equities investor long term, you need to invest in your knowledge. And you'll need to have investment exposure to the US market at some point, given its massive proportion of the global market and the hotbed of world-changing technology and innovation that it fosters. Investing in the US stock market creates diversity in your share portfolio. It offers access to far more themes and opportunities than any other markets in the world, which dwarfs opportunities that are available in Australia. So if you're looking to increase your knowledge and prowess in investing in US markets, then today's returning guest, Danielle Ecuyer, is the perfect person to help you. Because if you're looking for more clarity and confidence on how to invest in shares and equities in the US market in all of its myriad forms, then Danielle is your perfect complement. Danielle has been actively involved in the share market for over 4 decades. Beginning her career as an equities analyst and advisor, she held senior roles in large investment firms in both Australia and the UK. And for the past 13 years, she's been a private investor, where her main income source is derived from her own investments. So she walks her talk. If you want her full history, go back and have a listen to Get Invested episode 132, where we discussed her first book, Sharecity, which distilled her years of global share market experience into a handy guide to share market investing. Danielle has a happy knack of taking the complexity out of share investing. She explains concepts simply and in plain English, and she provides go-to steps to help you start or improve your investing. And she's recently published her very timely sequel, Sharecity 2, a guide to investing in US stock markets. Given the massive number of first-time investors jumping on the US share market bandwagon without any clear understanding of what they're doing, Sharecity 2 is very timely, and that'll give you some great insights on how to manage the challenge of the opportunities and the risks of investing in our continued times of radical uncertainty moving forward. Sharecity 2 is a clear and easily understood explanation of what drives US market valuations and how she sees the future of share investing. It's based on the simple and compelling proposition that we live in a time of incredible technological change, innovation and disruption, greatly accelerated by the pandemic, and that a lot of the big innovative companies riding the wave of the future are based in the US or listed on stock exchanges there, or form part of many major ETFs or exchange-traded funds. So if you want to invest successfully and ride this ongoing wave of disruption and growth, you need to invest there either directly in shares or through ETFs and equivalent assets in the US. In the current heady days of meme stocks, online forums and FOMO, Sharecity 2 is a refreshing introduction to the real world of investing in US companies. The book takes you on a dive into megatrends, risk versus reward and strategy, and walks you through the macro influences that will make or break future performance, while detailing what should form the foundations of every US share portfolio. By referencing other big minds, Danielle empowers you as an investor to take your own journey to investing in the US. She doesn't tell you what stocks to buy, though she quite rightly, unashamedly advocates for investing in future-focused companies, and she explains why. After reading Sharecity 2, you'll come away with a deeper understanding of how US markets work, why companies are worth what they are or aren't, and how to avoid losing money. And you'll find it easy to put your newly acquired knowledge to good use. In this way, Danielle's insights are a calm inner voice that you can draw on as you navigate the cross currents of investing in the US during these unprecedented times. So to whet your appetite to grab yourself a copy of Shareclicity 2, here's a little taste test on the story of Tesla versus Ford. It's Hollywood's grandest night on the film calendar, the Oscars. There's so much excitement around the latest blockbuster from the Netflix stable, Ford versus Tesla. The all-star cast is headed by Christian Bale, who plays the enigmatic engineering genius Elon Musk. Rumour has it that this is one of Bale's best performances, and the buzz is electric as the media and crowds wait for Bale and Musk to arrive in the latest self-driving Model S Plaid. Netflix jumped at the opportunity to produce and distribute this David versus Goliath story of Mr. Musk's sustainable energy and transport company, which saved the world from climate catastrophe despite the legacy giants of the 20th century, oil and internal combustion engine companies as represented by the Ford Motor Company. The tale covers the 30-year struggle and eventual victory of Tesla Corporation to accelerate the world's move to mass transport with electric vehicles, or EVs, autonomous robo-taxi fleets, semi-trailers, and renewable energy systems and battery storage. The almost cult-like religious following Musk and Bale have means that Twitter sphere is alight with anticipation of the award ceremony, which is being live-streamed right around the globe. Stop! Hold it right there, I can hear you say. What's all this talk about a new Netflix film, you ask? Danielle has lost the plot. There is no movie. There is no victory. There's no way one man and his vision can disrupt the $11 trillion automotive and oil markets. It's just not possible. Yes, you're right. There is no movie. Yet. And the story, well, 20 years in the making, is only just gathering momentum. As you'll discover, the story is in its early stages, but it represents one of the most profound disruptive changes you and I are going to live through. The story is equally important for appreciating the winds of change that are blowing through the US stock markets and how you can invest to make the most of all of the different dynamics of the largest stock indices in the world. Now, you'll have to grab a copy of Shareclicity 2 to find out where the book takes you from there. And Danielle has very kindly offered a free hard copy of the book to the lucky Get Invested listener who emails me at bushy@knowhowproperty.com.au with the best suggestion on why you deserve to get this free copy. And to further whet your appetite on the massive amount of great insights Danielle reveals in Shareclicity 2, today's wide-ranging discussion on all things equity investing goes into a really good understanding of risk tolerance, the impact of the financialisation of the world. We touch on the impacts of inflation, deflation, disinflation and reflation. Danielle touches on the megatrends that will affect investment markets in the future, including decarbonisation, digitalisation, fintech disruption, geo-borders, gaming, blockchain and cryptocurrencies. She explains what it means for companies to weaponize their share price. She gives you guidance on where to start in building your equities portfolio. We touch on ETFs versus direct stock picking. Danielle gives her views on the current talk about market bubbles and the dangers of leverage. She warns you about the risks of cheap trading platforms and the importance of knowing who are the custodians of the money that are behind them. And she gives her thoughts on emerging markets, along with much, much more. And if you'd like to join me and many other like-minded investors in our Get Invested community, then I'd love for you to join us right now. I send a free and exclusive monthly email full of practical self-help and wealth wisdom that our current Freedom Fighters subscribers can't wait to get every month. It's full of investment and lifestyle tips, my personal book recommendations, apps I use to enhance life, and much, much more. Just visit bushymartin.com.au and sign up at the bottom of the page, because this is just the beginning. In the meantime, enjoy this wide-ranging, fast-paced conversation on all things equity investment with Danielle Ecuyer. Hi, Freedom Fighters. Now, we live in a time of incredible change, innovation and disruption, which has been greatly accelerated by the pandemic. And a lot of the big innovative companies riding the wave of the future are all based in the US. Now, since the advent of COVID, after a brief drawdown, equities markets have gone absolutely ballistic around the world, especially in the good old US of A, with the S&P 500 index jumping to record highs and investors putting more money into shares in the last 12 months than the last 12 years combined. And this has happened alongside a massive increase in the number of new and active investors in Australia, reaching a record high of 1.25 million, a 35% jump over the year, with over 435,000 Aussies placing their first share trade in the past 12 months. And with the American market cap representing over 60% of the global's equities pie, it's a market you can't afford to ignore. But you need to be very careful about how you do it, particularly when irrational exuberance and FOMO are driving investors. So to help you enjoy the potential rewards while limiting the risks, at a time when a lot of commentators are talking about asset bubbles and possible busts in the US market, we're joined by returning Get Invested guest, Danielle Ecuyer, who has just released her second book, Sharecity 2, that actually focuses on the US market. So welcome back and let's get invested, Danielle.
Thank you, Bushy, and I'm so pleased to be able to come back and chat with you.
Likewise, it's perfect timing, and the book, your second book, is also very well timed in relation to what's happening in investment markets. And let me start by congratulating you on the success of your first book. I understand it's done well and continues to do very well, and really looking forward to doing a deep dive on Sharecity 2. So tell us, again, for those who haven't listened to our original chat on episode 132 of Get Invested, can you refresh us on who you are, what you do, and most importantly, why you do what you do?
Okay, so I was fortunate enough to trade as a share equities analyst in the late 1980s. I did that for about 4.5 years here in Australia. And that gave me the groundwork to understand fundamental analysis of looking at shares. And I then moved to London, where I transitioned to what's called institutional equity sales, which is basically selling the research product that I used to produce myself to large institutions, namely pension funds, what we'd call listed investment trusts, unit trusts, mutual funds in the US. So I basically did that for most of the 1990s, but I transitioned from the Australian market selling emerging markets, predominantly the small markets, as we called them, TIP, Thailand, Indonesia, and the Philippines, during the boom years prior to the Asian currency crisis and the collapse of Barings, where I worked, which was a bit of a shame because it was such a great operation. And then I transitioned because my markets basically disappeared. It was really, really hard. It was a severe bear market in emerging markets, which culminated in the collapse of a major hedge fund called Long-Term Capital Management that was supposedly the best hedge fund that would never go under. Well, lo and behold, when Russia defaulted on their sovereign debt, it took down Long-Term Capital Management, and was probably one of the first times that I became acquainted with the concept of what is systemic risk, which is basically an institution or institutions which have the potential to put the financial system at risk, and that was in 1998. I then moved to dabble in wealth management for UBS. It was a very specialised service in London. We were seeking to capitalise upon what is known as resident non-domiciles that live in the UK, that have a special tax status, to provide home office requirements for those very wealthy individuals. As life transpired, I ended up actually leaving the industry completely to have my son. My marriage didn't work out. I moved back to Australia in 2003. And post-2008, or start of 2008, I decided that I was not going to let other people manage my money anymore. I was quite capable of losing my own money, and I'd prefer to take control of my assets because I know myself better than anybody else. And I've been since managing both my investment portfolio that I live off and my self-managed super fund since the start of the GFC. And all of this culminated with my son doing his HSC in 2018. And I said, well, I think I need to, now that I've devoted those years to bringing him up and getting a very low golf handicap, which was great fun, I really needed now to reignite the grey cells. I didn't want them to get too sloppy. And I decided I wanted to write a book. And basically, a year later, Shareplicity, A Simple Approach to Share Investing, was basically born just before the pandemic hit last year. And during the course of last year, my enthusiasm for the US markets led me to write the second book, Shareplicity 2, A Guide to Investing in US Stock Markets. And lo and behold, when that was published, we went back into lockdowns here in Sydney. So just a warning to everybody, when the third book comes out, because there will be a third book, I'm determined to have a trilogy of Shareplicity, I will warn everyone just in case they can stock their cupboards, because we might be going into lockdown again.
Well, give me advance warning as well then, if you don't mind, Danielle. But if the third book is as good as the first two, then I don't mind going to lockdown because you'll actually give me time to read it.
That's very, very kind. It has to be something special, that's for sure.
Yeah. Now, I just while we're talking about the book writing subject, because having written two myself, it's not for the faint-hearted. What did you learn about yourself and things generally in writing the books? Because it's generally quite cathartic in terms of going through that process.
I found the first book a great learning experience. The second book was really, really challenging because the whole process of writing books really challenges one to be able to put on paper in a way that readers can understand all the complex topics that I, by way of example, have taken for granted that I understand. And it's almost like muscle memory. When you start looking at stocks and people say, well, how do you do it? And because I've been doing it for such a long time, I have a protocol by which I do it. But trying to actually describe that, explain it, analyze it and make it easy to understand is very challenging. And with the US stock markets, I'd been investing there since 2016. And I really underestimated, when I thought I'd write a book about it, the enormity of what I was taking on. So suffice to say, there were moments of doubt, to put it mildly, and the gestation period, as I said, for a while it got stuck in the birth canal if you were giving birth to a book. It really got stuck because it's a book that I think challenges the way people think about investing. It's probably one of the first books that I have come across that tries to encapsulate how to value growth stocks as opposed to your traditional fundamental analysis that everybody has learnt from Benjamin Graham through to the likes of Warren Buffett, where value, you only buy value, because clearly that paradigm has shifted post really the GFC, and more predominantly since around 2015. So the book was not only challenging to write because of the size of the market and how many stocks there are, but how to break up the pieces. And I'm very fortunate to have such a supportive partner who goes, darling, if you had to eat an elephant, which hopefully no one ever would do, you cut it up into bite-sized pieces. And basically that's how I approach the challenge.
Yeah, brilliant. Now, you've touched on a lot of stuff that I'm itching to get into. I want to wind it back a little bit in terms of just for the listeners' benefit, really, and given the prolific and diverse exposure you've had in the industry for many decades now, are you comfortable sharing with us what your personal investment approach is and the sort of system that you use to invest. And I'll underscore here that none of what we're going to talk about today is financial advice. But in terms of just general information, without getting into the nitty-gritties about the numbers, I'd love if you would share what your investment system looks like, given that you've been managing your own portfolio for some years now.
You really have to decide what you're trying to achieve and where you want to achieve it, because stock markets generally have become quite bifurcated in terms of this whole value growth narrative. So the first thing that people have to understand is, what are they trying to achieve by investing in the stock market? Point one, obviously, to make money, to grow your savings in excess of the inflation rate and in excess of what you're not achieving on a bank deposit. So that's a given. The next thing you have to understand, what is your time frame? The third thing is, how much money do you have to invest and how regularly you can invest. These are all the basic bedrocks before you actually start to look at how you allocate across ETFs, managed funds, or stocks. You have to have that backbone right, because it will largely determine what type of stocks you look to buy, I think. And also, it's very different from somebody who is aged 20 like my son versus somebody like me who's self-managed super fund. I want to grow it, but I also have to preserve the capital, because my earnings capacity was largest when I was in my 30s, and that's when a lot of savings took place. So how I approach it, Bushy, is I have two portfolios. The investments one that I live off, my self-managed super fund. The two are slightly different because the capital has been eroded a bit in the investment one, largely because we're renovating a property at the moment. So the investment one at this point in time has been targeted to try and pick up income. And it has also been, if I make 20% on my money, I've been inclined to probably be a bit more proactive to take profits. The self-managed super fund, in comparison, I've really, really looked to buy quality shares. It can be across either a value or a growth narrative. But bearing in mind, when I talk about value or cyclical stocks, you have to be aware, no matter how good they are, they have the potential to come under more pressure when there's a downturn in economic activity versus some of the growth stocks, which were what exposed to a secular trend, which basically is what we will touch on a bit in the book. But to give everybody an example, it's the theme, let's say, of cybersecurity or decarbonisation. And so once I've worked out the parameters of what I'm trying to achieve, if names come past me, I start to take a very pragmatic approach, which you can do online, either looking through the likes of Yahoo Finance, Google Finance, CNBC. Here in Australia, there's the ASX, and you start to just basically get a snapshot of the company. What do they do? Have they been around for a long time? What's their stock performance like? What do their financials look like? And once I get that snapshot, if it starts to interest me, I then start to take a deeper dive into the company. And then it has to tick criteria. Can I fit it in the portfolio? Is it going to give me secular growth trends? Do I think it's more of a short-term trade? Do I like the business? Do I like the management? And really, the key thing for people to understand is that I don't think as individual retail investors, we need to be the expert analysts, because you will use a lot of energy and time trying to replicate what people that are usually far more in tune, not necessarily smarter, but do the job day in and day out, analysing these companies. So our job is to interpret the information that those analysts put out there into the investing universe and say, do we agree with the thesis or the premise that they're putting forward? How does the stock fit in a relative valuation? And is this a stock I want to hold for 1, 2, 3, 5, or maybe 10 years. Obviously, 10 years is a very long time, and a lot of things can happen over that time. So I have this process. I would say to people, if you have a lump sum of money and you're trying to get it into the markets, it's a lot harder than if you've been sitting in them for quite a while. It's much easier if you've got an existing portfolio and you're just adjusting it, taking some profits here, maybe adding a stock there.
Yeah, no, very well summed up, and a lot of stuff that we can dig into there. Something I like to dig into with investors like yourself, because our biggest learnings often come from our biggest challenges. Are you happy to share what's been your worst investment ever to date? So tell us a bit about the circumstances and what you've learned from it.
Yeah, I thought this is a really fun question to answer. My worst investment is basically not learning from my own mistakes. So what is that great expression? Like, you expect a different outcome by continuing to do the same thing. So this leads to a story of why I will not invest in unlisted vehicles. I have a complete phobia about not being able to access the capital should we have a market meltdown. So in the late 1990s, when the whole internet boom was starting to take off, I invested in a nanotechnology company, very early stage, more seed capital, venture capital. And they were able to it was to accelerate the transfer of information along the internet. And the company was real, it existed. It was working with MIT in the United States. So everybody has to visualize, I'm sitting in London. London and New York are the heart of finance. This amazing, rich US millionaire comes across and he's basically selling stock to, individuals. I was exposed, I bought some, everything's going swimmingly well. This is all unlisted.
Yep.
And they basically then come around for another round of funding, which is how it works.
Yep.
And they're suddenly saying, look, Danielle, would you like to sell your stock? We've doubled it. But the Vanderbilts or the Rothschilds or some big family want to, put more into the company. Little old me thinks, oh, no, I'm not going to be a short-term investor. I'm going to really hang on to this one. And I don't know if I told you this story, Bushy, in the last podcast, but basically the owner of the company goes, oh, geez, everybody wants a bite of this, including the biggest, family offices in the United States. You know what I'm going to do? I'm going to bankrupt the company and take the technology and just take it for myself and redo the whole company, recapitalize it. So everybody lost. Fortunate I didn't lose an obscene amount of money because I never put that much into any one investment. But you'd think I would have learnt my lesson. Wrong answer. So come to the 2000s, and I can't remember exactly when, but I was feeling like stock markets were fairly fully priced, and they probably were. And instead of just sitting and waiting for a market correction, oh no, I saw an ad in the AFR for high net worth individuals or wholesale investors, because, you can be a wholesale investor without being a multi-millionaire.
Yeah.
And yes, I was the numpty that went and bought some fantastic sandalwood trees up in Western Australia, which I then just wrote off the entire thing when they asked for another round of funding. And from then on, I go, okay, if we learnt our lesson now, we are not a large enough investor to behave in this way. And if you do it one more time, I'm going to shoot you myself. And if you can't find anything decent to buy, the answer to the question is don't buy anything. And this is pushing one's investment portfolio too far outside of the risk curve. One can only make investments, in my humble opinion, like that when you spray it across 20, 30, 40, seeded companies, because on balance, most of them are going to go bust. And another example was in 2013, when there was very much a trend for self-managed super funds to invest in property. Yeah. And I put together a presentation with a gentleman who's a proper analyst, and we were looking at just raising some capital, putting together, the vehicle, and some people putting their money into an apartment in Liverpool up here in Sydney. Yeah. They all balked on me, which was a shame because we actually would have done quite well, but it doesn't matter because I did well in the share market. But the irony was, and this is no slight on this analyst, but he decided to put all of his funds into an unlisted company that invested in retirement villages. And I wasn't comfortable with that proposition. Again, he felt the share market was too expensive. He thought that you had to go to the unlisted markets to get a return.
Yeah.
Well, I'm not sure how that story ended, but I would have felt very uncomfortable in the last 18 months being exposed to that sector. And I guess, again, it's all about people understanding their risk tolerance, how much you can afford to potentially lose. And I know that might sound negative, but that's pretty much how I manage my money, because I have this thing, never say never. I've seen that many great companies go belly up, that I have a view that you never want to have too much exposure to any one asset, that it becomes too deleterious to your own capital.
Yeah, very good learnings and further reinforcement of the need to diversify and not have all of your eggs in one basket. No, awesome. Let's just wind back a little bit if we can, because I'd love to get you to define for us, because everyone's got a different view of what investing is, what trading is, what speculating is, so that we're all on the same page and regular listeners can sort of pinpoint where it all sits as far as you're concerned. Can you sort of give us a very brief definition of those three terms, so the difference between investing versus trading versus speculating as you see it?
Yeah, absolutely. Let's start with investing. Investing is buying a company which, if you were to look at a share price chart, the line would start in the bottom left-hand corner and it would rise to the top right-hand corner, and you can buy at any point along that line and you will make money. And there are multiple examples of companies like that here in Australia and over in the US. And they're the companies that just grow and grow and grow, and they become that term, the 10-bagger, which I absolutely loathe, as when they go up 10 times. They're the ones that you can hold, and it's not that you set and forget, but you hold them, and if they become too large a proportion of your share portfolio, you might want to trim them. Equally, if they sell off post a result that would be happening around now, which is earnings reporting season, you can say, okay, there's some short-term headwinds for this company, but I have a high degree of certainty, probability that the company over the next 5 years is going to continue to grow earnings. I'll buy some more.
Yeah.
Speculating, let's go right back to the other end. Speculating is buying a company that has a so-called product that hasn't come to market, that is a so-called lithium mine that still hasn't started, that has a biotechnology that they haven't actually brought to market yet. It is basically a story, a great story, but there's so many potential capital raisings, regulatory hurdles, competitive pressures, everything else that you can throw at that company. If you get one of those right, one has to understand, like if you take a punt on one of those, like new lithium mines, because that is the sector that's running super hot, but they haven't started production, you want to be pretty sure that the company that is doing that mine has a great track record, has done it before, has great management. They haven't gone to, well, Ulaanbaatar is the name that comes to mind. I'm just throwing that out there. But going somewhere where you may suddenly find that the government decides they want to sequester the assets, for example.
Yeah.
So that is speculation. In between, you have trading where you say, you know, there's been a sell-off in the iron ore miners because the iron ore price has retreated, but actually I'm pretty bullish still, so I'm going to buy some Fortescue, and if it goes up 10, 15%, I'm going to flick it because I have long-term concerns over the longevity of the price rise of iron ore.
Yeah, got it. No, that's very well summed up, so that we're sort of clear on where that all fits together. Awesome. So what I'd love to do now then is jump into Shareplicity 2 and sort of get you to expand on who should read it and what are the key messages, if you don't mind.
I think there's key messages. I was one of the questions that you sent to me was, what is sustainable success? And I want to touch on this because I think it leads into the reason why you want to read a book like this. I define sustainable success as what we saw people and companies do at the start of the pandemic and continuing to do. And it's basically resilience. It's the ability to adapt. It's the ability to move through issues and problem solve. And also knowing when to give up or when to cut a loss. And I guess part of having sustainable success is that one continues personally to grow, and one is never afraid to learn more, and one is never afraid to change one's opinions. So the premise of this book is that I felt like, oh wow, suddenly the world of technology and innovation allows for everybody in Australia to gain exposure to the US stock markets. I would like to share why I think that's a really, really good idea. And it is predominantly based on the fact that as we head further into this decade and this century, the world is facing a lot of changes, there's a lot of disruption, but it is a paradigm shift in the same way as it's been compared to the 1920s. You could actually take it back to the railroads. There's that much change going on. And as an investor, you can either sit back and say, I don't want to be part of that. I'm just going to stick to what I always did because that's worked in the past. Or you can say, actually, I'd like to learn about this. I'd like to find out, well, what is this whole thing about electric vehicles? I mean, is it really what it's cracked up to be? Or I've noticed that my accounts have been hacked. I should know more about cybersecurity. And how do you invest to capitalize on those trends? So I felt I have learned all this amazing stuff. I've bought incredible companies. I haven't had to buy small market cap companies. And I've been making great money. And it's also intellectually interesting to be involved. Of course, you can be really involved or not so involved because the financial products out there allow you to take how involved you want to be. But the point of the book is really to open up everybody's eyes, to hopefully stimulate them to think, wow, maybe I want to be part of this. Because as great as Australia is, on the technology front, while we have some great companies and there is a constant push to have more, at the end of the day, the US is fighting it out with China in a Cold War to be the technology leaders of this century. And it is still the one reason I say I go to invest in the US. It's for innovation and technology.
Yeah, beautifully said. And it answered a question I was going to jump into. Sort of putting this in the context of the global situation and given the exposure you've had to many markets over the years you've been active in the space, why the US and how does this compare to some of the emerging market opportunities, for example?
Look, emerging markets predominantly, I can't remember off the top of my head, but China represents the largest portion. It's still considered emerging.
Yeah.
Emerging markets have been emerging for years. I was there in the boom times in the 90s.
Yeah.
And it's really sad. Some countries have lived up to expectations and beyond. So we're talking Taiwan and Korea that moved past emerging markets in the 90s, and Taiwan has the number one semiconductor manufacturer in the world, which is very valuable, that obviously China wants to get their hands on and the rest of the world wants to keep it to themselves. I think the point is that when you go to emerging markets, you take on a lot more sovereign risk.
Yeah.
You take on a much higher exposure to what the US dollar is doing because a lot of them have US dollar denominated debt, and that affects their own currencies. You have really much less transparency in the capital markets than you do here, and less regulation. Yeah. And the reason for emerging markets is, quote unquote, you're riding the demographic wave. But really, it's not like you don't have to have exposure there. but I think you have to think very seriously, is that really something that I need to have exposure to? So China is, to me, I would only ever buy a Chinese ETF. I did hold one called KWEB, KWEB in the US. Yeah. And the problem is that you get those crackdowns like we saw a couple of weeks ago, and all the Chinese stocks fall out of bed, so to speak. And you've got to be able to handle that volatility. For me, sometimes it's like a headache too far. I can make good enough money sitting in the US, where I know I've got the largest, most liquid, regulated markets, ditto normally with Australia. Do I really need to push myself out the risk curve that much? And the answer is that I say is no. I don't need to. So I think emerging markets may have a company here and a company there that you might want to have a bet on. Do you have to have a large chunk of your portfolio in them? I don't think so. I would say that you can still make great money in secular trends in the US, and obviously all the other markets in the world like Europe and the UK, they're very, very mature. They're mature businesses, so they're much more cyclical. And that's kind of what Australia to a large degree is as well.
Yeah, beautifully said. Well, let's jump into some of those past and future macroeconomic indicators, along with the sort of major mega trends that you see as driving sectors and equities growth moving forward. And because you cover that very well in the book, can you sort of open our eyes and ears to what that looks like?
The most important thing, the book spends quite a bit of time discussing some research that was done by two very smart gentlemen, both of whom I had the pleasure of working with at Barings. And in the third chapter, we look at the macroeconomic overview of the US economy, where it got to, where it's potentially going. And I cite the works of Michael Howell, who does global liquidity analysis. And he started that in the 1980s at Salomon Brothers before he came to Barings. Now he has his own operation in London. And the other work is from Victor Schwetz, who is Macquarie Bank's global strategist, who wrote an amazing book for anyone that's interested called The Great Rupture. And it's a very extensive look over history about which cultures were successful and where we are currently and where the world is going. And so I wanted to explain to people that you've obviously had 4 decades of interest rates coming down. We all know the story that monetary policy has been used. It started with Greenspan after the Volcker era, where Paul Volcker was squashing inflation out of the system, for those of you that are old enough, in the early 80s, when you could put your money in a cash management account like my mother did and got 14%. Thanks for coming. Times have changed dramatically. Every time we've had a recession, the central banks have responded, the Reserve Bank, the Federal Reserve, the Bank of England, European Central Bank, and they've responded by dropping interest rates because there've been this absolute loathing by governments because of debt and deficit and balancing budgets that they don't want to have any fiscal spend. So where does that leave us? It leaves us with the fact that the globe is now heavily indebted. We have very low interest rates. In Europe, we have negative interest rates. Comsec had on its account the other day that if you actually have cash in Swiss francs, they will be pinging you. Well, they won't, but the Swiss Central Bank will be saying, thank you very much, but you're going to have to pay over 2%, over 100,000 Swiss francs to basically hold Swiss francs, i.e. we suggest you don't do it. Could you please go out and invest it? And the result is that you've had this massive growth in financial assets. Seen a boom in property around the globe over the decades, huge boom in the last 18 months thanks to the massive QE stimuluses. You've seen the same in stock markets. Yep. And you've also had an increase in the amount of industries that are effectively involved in the finance sector. So it's become the financialization of the world. We can whinge whether it's right or wrong. The fact is that is what it is. Now, the reflation of economies post the recessions, those short, sharp recessions last year, has now raised the spectre of, are we going back to the inflation of the 1970s? There is a camp of people saying we are, and then there's the camp of people like the likes of Jerome Powell, the Federal Reserve, that this is transitionary inflation. There's two things that I want to leave people with. That first of all, to grow economic growth at the moment, you need $4 of debt to generate $1 of growth in US GDP, and that's increased by a factor of 4. There is so much debt now that you would argue, is it ever going to be repaid? Probably not. Even if I think inflation there is still very much what we call disinflation and deflation that's arriving out of demographics, innovation, disruption. EVs is a classic case in point. There will be massive deflation in that sector because electric vehicles will not use a fuel. Well, they will energy, but if it comes off solar panels, it has a marginal cost once you've, put the solar panels in. So I don't think inflation going forward, people get very confused because they say, well, particularly this week, we're going to see some numbers coming out in the US, the CPI and the PPI. They could be quite high, but you have to question a year down the track, are you going to see the same percentage growth year on year? The Federal Reserve is saying no, but that doesn't mean that you're not going to see a corresponding reaction in the bond markets, the 10-year of Treasury over in the US, and also concern by the markets. I think at the end of the day, as Victor Schwetz puts it, is any politician or any central banker going to put the whole global financial system at risk so that people actually see the value of their houses halve? And I think the bottom line is that the circumstances are not the same as the 1970s. You don't have the same wage pressures from the unions. You're not seeing the same potential problems with the oil markets because actually where the world is trying to transition away from it. So while there might be inflationary pockets and maybe some scares, I think on balance the world has probably changed. And you never say never, but I think that I take the view that you are going to see, and this is what Mike Howell puts forward, continuing QE programs, because it is no longer just about supporting economic growth, it's about refinancing or rolling over the balance sheets. And the balance sheets are the personal balance sheets, the government balance sheets, and the corporate balance sheets.
Yeah, very well said. And that really does put some context around that, because you're right, there's a lot of commentary from all and sundry around inflation at the moment. And I tend to totally agree with you in the context that it would be a pretty dumb government who decided to start playing with those levers when the reality is we need to be keeping the situation on an even keel, both at a personal and a government level, to be able to service the debt that's ongoing. And there's no major pressure really, except for if you're one of those emerging markets that's relying on currency from someone else. If you've got your own currency and your government and your central bank are working in tandem, then there's no real need for that to occur. And yes, there'll be a little bit of transition, as you well discussed. But I think the learnings now and the smarts that sit within decision makers in that level are going to ensure that they're not going to put our houses at risk by doing something stupid in the interim. So very, very nicely summed up there. Are there any other major mega trends that you are seeing that are likely to be driving sectors and equity growth moving forward?
Yeah, so that's the next part of the book. So just to give people a brief outline, I compare what I call the 20 giants in the US, the 20 major companies, and it's quite an interesting chapter, and I'll let everyone discover what it is. But it's basically trying to compare how companies have changed over time, which were the giants, which are no longer the giants, and why the likes of the FANG stocks have moved to the largest stocks in the US. But we move on to the megatrends, which are really important. It's about secular growth. So it's these massive changes that started in the 1970s with computing and has just continued to move on. There's quite a few of them, so I'll just give a quick summary. Post the IPCC report, really you'd have to have your eyes wide shut. Literally, decarbonisation is the biggest challenge in the world, and it is being very much embraced if we can just remove the politics of Australia, because when you look at financial markets, whether it's insurance companies, whether it is pension funds, superannuation funds, BlackRock, Larry Fink's company, the second largest ETF provider in the world, the likes of Morgan Stanley, Citigroup, all the big banks around the world, including the central banks, the risk around the risks and opportunities of decarbonisation are broadly $2 trillion plus per annum. That's how much is invested currently in fossil fuels. We will require at least that, if not more, to decarbonise. And it really was summed up by Mark Carney, the former head of the Bank of England, as well as Larry Fink. These are the opportunities. These are also the risks. And really, no company will not be touched by this. Then we move down to some of the other ones, and it's interesting because it's kind of like a network or a flywheel effect, because with the ongoing e-commerce trends, which is huge, digitalization, that leads to more cybersecurity needs. We've particularly seen this in the pandemic when we're doing a stay-at-home, work-from-home or a hybrid model. Yep. You also have cloud and edge computing. So cloud are the big data centers, improved services, more businesses transitioning to cloud, more enterprise cloud software. And edge computing is for electric vehicles and the Internet of Things, and we'd be facilitated through 5G. Then you have some other trends that are also, fintech is a huge one. Obviously, the Square deal with Afterpay is a classic case in point. CBA responding by dropping the fees for Klarna, which they are involved with in the buy now, pay later space. I describe how in many ways the geographic borders were raised during the pandemic. Everybody shut their borders, so we became geographically more isolated. But in the same breath, because of the internet, all those borders melted away. Now, the same thing applies in the finance space. Those physical borders that have protected the likes of our banks here in Australia are going to consistently be chipped away at by the likes of these fintechs. And to give you an example, Jamie Dimon, head of CEO of JP Morgan, he basically said, should be, SH.T, scared with the emergence of the likes of the growing strength of the PayPals and the Squares of the world. So you have to visualize that innovation and technology, it doesn't care about a physical border. And unless governments are really going to play hardball, but even then you've seen how hard it is with the likes of Google and Apple. And this is the thing, that those companies, they don't see it. It's not a supply chain where you just cut it off. They just go literally through the ether, so to speak, although it's not the ether. Other ones that are really, really big are telehealth, digital medicine, and the other ones are gaming. This is a really big one. Facebook, Google, and Apple all moving into augmented reality in the metaverse. Mightn't be for you and I, Bushy, but there's a company called Roblox, which is a gaming company for children. Minecraft, some people may remember, but it is in a virtual world where they have their own money, etc. So these big tech companies, all they're trying to do is create another operating system, which basically is another space to get our eyeballs onto for us to open our wallets. And they're incredibly innovative of trying to find ways for us to part with our money. And the other big trend is online gaming and sports betting, because a lot of the casinos that were had to shut down over the period, the state governments are now allowing legalising online gaming and betting. And there's quite a few companies in that space, including Australia's own PointsBet over here. So they're the major ones. The numbers are quite eye-watering. You've seen some massive price performances out of specific companies in all of these sectors, and most of them tend to have some form of online digital presence, and that is why, because the growth rates have been so high, that the valuations have been pushed up so high in a low interest rate world.
Yep, very interesting. What's your your read on blockchain and the and cryptos in relation to how that weaves into the future.
I think digital currencies for, the central banks are definitely coming. I am so not an expert in this space. Blockchain technology, it'll be interesting to see if the ASX can get that over the line to replace the chess system. I think that you clearly have the true converts. It is being accepted as payment in kind over in the US. So it really begs the question, how does one regulate it? Are the central banks going to regulate it? Or really, will it be a case of using the blockchain technology specifically? I understand for Ethereum, that's the best one, that it's based, the best blockchain there is. Mm-hmm. Whether the central banks are going to try and wipe out the digital, the cryptos with their own digital currencies. But to suffice to say that I think we've still got a lot of change ahead of us. I think this is really if we went back to the 1990s, late 1990s, when everybody was having internet parties, like what e-commerce business were you going to do? The same thing has been happening in London with cryptocurrencies over the last 6 years. And I think it's probably just at the start of a long development phase.
Absolutely agree, and I think the key word there is change, because I think change is accelerating, and it's not going to go away anytime soon. So the sooner we recognise and embrace that as an opportunity rather than see it as a threat, and I love the analogy you use in your book. The story about Tesla versus Ford, I think is a great example of exactly that. And getting clear on where we position ourselves moving forward is important in that regard. So, no, that's awesome. Now, a couple of things that I'd also like to dig into, which you expand on extremely well in the book, I think, is what drives share valuations, because it's a subject that I don't think many people have really got their heads around. Can you expand on some of the key points that you discuss in that regard?
Yeah, I tried to take quite a good look at this, and this is one of the byproducts of when you actually start to have to put words on a page and realise that you can't sound like gibberish or Jabberwocky or something like that. I've got a quote here from Morgan Stanley that I really, really think sums it up beautifully, and it says, "Creating shareholder value, that's what we want. We're stakeholders, shareholders. We want to have value from investing in a company. So a company's objective should not be simply to grow. It should be to grow such that it creates value. A company creates value when its investments earn a higher return than the opportunity cost of capital." Sounds really simple, but clearly not always as simple as one may think. And the bottom line is that we just don't want growth in isolation. We want that thing that a company continues to invest to grow for the future, but the return is in excess of that cost of that investment. And what has been really, really interesting in the last 18 months, you've seen these major tech companies being able to weaponize. It's such a great expression. It comes from a guy called Pierre Ferragu, who is a tech analyst in Paris, super smart guy. He analyzes Tesla. And he said, Tesla weaponized their share price. What does that mean? It meant that they could go to the market and raise billions of dollars of capital very cheaply. And in obtaining that capital very cheaply, they are then able to invest in all their new gigafactories to create the electric vehicle manufacturing that they want to do. And that's the whole point. It's companies, whether you're investing in enterprise software, whether you're investing in streaming services, like Netflix is really interesting example. So Netflix is only just starting to make money. Yep. But the big question mark for people is, given how much that they have to spend on their content, is that model, has it got longevity for shareholders over time? Because they have to basically increase the subscriber base / revenue per subscriber to justify the cost of the content. And that debate is not finished yet. And they have to do that in the context of Disney, of Amazon, of Apple, all moving into the same content provider providing in the streaming space. So anyone can invest to grow, but if your losses just keep on compounding over time, then that's a terrible investment. And that's the whole premise of the book. Growth is great, growth is excellent, but a company cannot continue to generate ever greater losses going forward. And that's really showed up in this latest reporting period in the US. The growth companies, which usually don't report a profit because they're investing in more people, more software engineers, more coders, etc. They basically are growing their revenue at 20, 30, 50, sometimes 100% plus. But people want to see their gross margins improving, and they want to see the losses at the bottom line decreasing. And the ones that have seen them expanding have really suffered quite heavily at the hands of investors saying, not good enough, your model's not going to survive.
And that's given the merger and the blurred lines between a lot of the players in that space. That's going to be a very interesting game to watch moving forward. Who survives? Who gets through that? And who?
Absolutely.
Yeah.
And it's a winner-take-all situation, and the stronger are getting stronger. And the pandemic has really thrown that into the fore. I think that it's going to become, we will look back in this period and it'll be quite clear. We will say, oh, why didn't I see that in retrospect? Because the strong are really getting just much, much stronger. And whether it's their ability to borrow more cheaply, to weaponize their share price, Square has done it as well with Afterpay. They're the ones that are going to come out shining. And then there's going to be a whole lot of Me Too's that are literally going to be, singing, what about me? And it's like, well, sorry, you didn't make it. And that is basically the way it's going to go. And the same thing's happening in the electric vehicle space. I mean, there are so many manufacturers. You've got the incumbents racing in. You've obviously got Tesla who's leading it. You've got SPACs, Fisker, that are turning into companies that are prototypes that they're going to bring to the market. At the end of the day, all these companies are going to come in and try and compete. But in 10 years' time, we'll probably still go back to very concentrated oligopolistic structures of major EV producers that also potentially have that autonomous driverless vehicle taxi fleets, which is obviously something that's been meant to arrive. It's a very slow train coming, but it will come eventually, I think.
I totally agree, and that sort of begs the question then of it's something that I like to talk to investors about, and that's this argument around picking winners, as in individual stocks or shares, or ETFs or indices or other diversified instruments. What's your read on that situation as an average investor? And we're talking about a retail investor here, mums and dads who are looking at where they're going to stick their money. What's your view around that?
The view is that I always say you start your backbone of the portfolio with potentially ETFs, and you have the choice of buying them either in Australia, because the list is growing. There is such a huge push by the ETF providers. There was a handout in Australia's rather large flagship financial paper this week with a lot of ETF providers. It was advertorial content is how I would describe it.
You're being polite, I think. I think you're being very polite there, Danielle.
About ETFs. And so investors are going to have more ETFs to choose from than they know what to do with. The backbone, though, is basically if you want exposure to the US markets, it's much easier to go and buy, which I did years ago, iShares IVV, which is quoted here in Australia, and that'll give you exposure to the S&P 500. You can equally do that in the US, and the reason why I have direct holdings into the US and US dollar holdings, it's actually as diversification away from the Australian dollar. I don't want everything in US dollars. I don't want everything in Australian dollars. I want some diversification there. Then after you pick your ETFs, either in Australia, listed on the ASX, or over in the US, I always say you can add the RIBs to the portfolio, and the RIBs are basically the ones, those stocks that you've done a bit of research on, that you really think are going to be the next Apple, Microsoft, REA that we've had in Australia, or CSL, the ones that you feel confident that you can actually just say, I'm going to put this in the bottom drawer and know that it has the capacity to grow at a compound rate of 10% per annum plus over the next 5 to 10 years. And they're the ones that really are the wealth game changers, in my humble opinion. And clearly it will depend. I always say it's really hard, like if you want to play lithium, it's super hard. Okay, in Australia, there's lithium companies that have been doing, like Orocobre has just been on the biggest tear. My son keeps going, Mum, oh my gosh, oh dear, I should have bought it a week ago. And now he's like, oh, this has got to fall at some stage. So you can either pick a specific, let's say, lithium play for exposure into EVs. And when I cite these examples, they're purely examples. I'm not saying anybody goes out and buys them. Or if you feel like you don't want to differentiate between buying Wesfarmers Mineral Resources, Orocobre, Lake Resources, which is a new emerging lithium play, you can actually buy an ETF which gives you an exposure to that, which is what I did in the US. And lo and behold, I think it's up 48% in the last few months. I didn't even realize it had gone up that much. So I say, if you're not comfortable buying into the cannabis space or the online gaming or cybersecurity is a classic case in point. There are a lot of really good software, cybersecurity, cloud-based software, cybersecurity stocks. I've held CrowdStrike for quite a long while now. I bought it after it listed at a reasonable price. But the problem is there's a lot to choose from. And really, unless you're an expert in that area, it's very hard to pick. So sometimes it's better just to buy the ETF. And I think the ticker code for one in Australia is HACK, HACK, run by Beta Shares. And you can basically say you can get exposure to cybersecurity, secular trend, and it will have all the more expensive players plus some of the majors, because obviously Microsoft is in that space as well. So I say, where you don't feel like you can pick a stock comfortably, that you understand it, it's usually better to look at the ETF. But when you buy the ETF, just have an understanding, have a look at the major shareholdings, because the top 10 will usually represent a large proportion of the ETF, and just make sure that you're comfortable with holding those underlying group of shares in the ETF. And one other thing just to be aware of, there are now active ETFs coming to the market, which are like managed funds but much cheaper. And active ETFs are basically the ETF wrapper, because that's all it is. It's the lolly. It's let's say if it's the cookie jar, and all the stocks are the cookies. And now fund managers, Kathy Wood is a famous one in the US for ARK Invest, for her buying very high growth, change makers, sometimes quite speculative. She has ARK Invest managed funds, active ETFs, and there is a trend going in that direction as well. And you have seen the likes of Magellan and Hamish Douglas moving their platforms more towards a managed ETF platform.
Very well said. You mentioned your son's concern around emerging asset bubbles, and there's been a lot of commentary in recent times all over the place in most asset classes in relation to the potential emerging asset bubble and the potential downsides that might be coming. What's your read of that, and what's your suggestion in relation to what investors should and shouldn't be doing in coming months as a consequence?
The key question of whether or not you're going to have we're going to have a correction at some stage. Typically, corrections of 10 to 15% are quite normal, and investors have to be prepared for when that happens. When does it happen? Well, Bank of America have been calling that literally for the last year. So they're still calling it, but it hasn't happened. One day they'll be right. Generally speaking, the investors that do best are not the ones waiting for that big crash, because they never become invested and they never make any money. And you can, in the same way that you can get drawn into an irrational exuberance, being overly fearful is not going to get you anywhere. And it again goes back to the thing that the system will perpetuate itself over time, and governments are committed to sustaining these very, I suppose, mature economies. The economies that we have now are not what they were in the 1950s, post-World War II. Well, they are. I mean, sorry, I probably should couch that better. In some ways, they are, because you've just seen the US infrastructure package coming in. And the reason why it's coming in is not only is the infrastructure run down, but they know that the monetary policy cannot continue to do the heavy lifting to keep the US economy going. And in the same way, if China's demand for our iron ore falls off, if we don't have robust property prices, you can bet your bottom dollar that I don't care how fiscally conservative the government is, they're going to be basically investing in infrastructure projects, etc., to keep the economy going. Yeah. So I think the point is that you want to have a list of your favourite stocks. When you see them sell off, which they always do, that is the time to go in and buy them. I'm not saying go and buy REA, but that's a classic case in point where the results slightly disappointed because they're investing for the future. There's all these question marks because of the lockdowns and the election next year. So everybody's been selling down REA. If you are bullish on property going forward, well, clearly you'd use that sell-off to possibly add to a company like REA. And that's really how you have to look at it. You want to go shopping, but you don't want to go shopping paying full price when possibly you can get these stocks on sale. How much cash you keep on the sidelines for the drawdowns, that's personal. Sometimes people have 5%, sometimes it's 10% of the total amount. Or alternatively, how some of the fund managers do it is that they say, well, I'm going to hold a really, really solid, maybe dividend stock, keep my money in that, and when the drawdown in the markets comes, that will go down less than, let's say, some of the technology companies. So what I do is I sell that old stalwart to invest in some of the high growth companies where I want to put my money. So in terms of bubbles, I think you're seeing selectively bubbles everywhere, and it will be a case of when you do have a drawdown, there will be a shakeout of some of these new investors that are either too leveraged, too many margin loans, or too many option plays that don't work out, and they will probably get their fingers burnt. But sometimes that needs to happen so everybody has a reality check.
Yeah, totally agree. And sort of feeding into that, some of the activity we've seen with the, reasonably recent, although recent's relative, given the sort of Reddit herd training phenomenon and what happened to GameStop and some of the others. But what's your read on that sort of activity?
Well, it's just, it's probably misguided, but it is what it is. It's not what I get involved in. I don't like holding meme stocks. And I'm wary that if any of my stocks do fall into that kind of meme stock category, because the herd will carry them far too high for a period of time until they all lose interest. And whilst some people have termed it the democratization of investing, to me it's more a case of platforms like Robinhood really duping the smaller man in the street into parting with their money so that they can make money off of them, not through the traditional sense of the fees in trading the shares, rather that they sell the user data of their platforms to the big hedge funds who pay top dollar to get this. So I think it's a bit sad, but it is what it is. And for all investors, they need to be aware that we've seen these bubbles that many times before. It's not a new phenomenon. It's just always a little bit different, so that people confuse new with different. But we had Poseidon, which my mum lost all her money on in the early 70s. We've had that many companies that were once fabulous companies that have since disappeared. So I think, as always, you have to have your eyes very much wide open and just realise when there's a lot of excess liquidity and hot money running around, it's going to push some of these stock prices or cryptocurrencies well beyond what is absolutely, feasible or reasonable.
Yeah, extremely well said and well summed up there. You touched on leverage during some of that discussion. What's your view on leverage into equities?
I don't think it's a good idea. And I would definitely not. I was reading a financial journalist, a journalist who supposedly is learning about shares, discussing whether or not they would draw down more on their mortgage to put in the share market. There's no words for that. That's just, don't do it. You have to take a long-term view to investing in shares. And I think people have got too greedy and expect too much too quickly. And the GFC wiped out most people that had margin loans, that had leverage. And I think that people are getting confused thinking ETFs are like a bank deposit. They're not like a bank deposit. And they're complex financial products. They can go up and down. Some ETF products may even go under or just cease to exist. So I think that you really putting leverage into the share market, you've just got to be prepared to be able to take the hits, and not many people are. And I'd never take out equity out of a property ever to put into the share market. I just think that is, anybody that suggests that, you suggest that it's just the system is too big to fail. And whilst the system is too big to fail, it doesn't mean that it can't creak at the seams. And as an investor, you don't want to be the one that gets wiped out when it creaks at the seams.
Yeah, spot on. Yeah. Really well said, as usual. Now, that's painted a fantastic context, I think, to really getting down to the nitty-gritties of what the listeners need to start thinking about if they're going to be investing in the US. And we've covered some of these already, but what do you see as the biggest mistakes that Aussie investors make when investing in the US, and how can they avoid them?
I think you've got to be really careful of those cheap trading platforms with zero costs, because it encourages too much speculative behaviour. That's the first thing. The second thing is somebody at the Australian Shareholders Association asked a question about counterparty risk custodians. So in Australia, you own the shares in your own name through the CHESS system. In the US, they're held by custodians. I know for a fact that CommSec, while you pay more to trade through CommSec, the custodian is Pershing, which is owned by Bank of New York Mellon, which is an absolutely massive global custodian. It survived the GFC. It doesn't lend out shares. Again, my son was looking at another platform, and I said, well, check the custodian. So who's going to be owning your shares on your behalf for you? Who holds them? And he goes, oh, this company. Oh, that's big. And I said, well, compare it to Pershing. And he went, oh dear. Okay, it's not that big. And my point is that when Barings went under, clients had their money held in custodianship through Barings, Taiwan and Korea. And when we were going bust, the clients were absolutely hysterical for 24 hours, making sure that they didn't lose their clients' money through Barings going under. And I think the point is that with any trading platform, if it's zero cost, you've got to ask, how do they do that? How secure is it? And again, if the system creaks at the seams, you want to be in the most stable financial institution where you know that you're not going to lose your shares. And one case in point was another zero cost platform who actually insures their owning of shares in the custodian through Lloyd's Underwriters in London. And I guess I just want people to read the fine print, because sometimes I think technology is great, but it also comes with a whole new set of buyer beware caveats. And I sometimes prefer, it's like buying a really good pair of shoes, a really nice saucepan, or sometimes when you buy, I like buying quality shares in the same way. I'd prefer to be with a quality platform where I can sleep well at night knowing my money is going to be safe and my shareholdings are going to be safe, and where I'm not inclined to overtrade it or churn the portfolio. Because I'll tell you now that at eToro, 67% of their traders lose money.
Yeah, exactly. Yeah, very good point. That's a very good point. What was that stat again? How many?
67% in Australia. It's 67% lose money on eToro. And Robinhood won't tell people how much people lose money, but it's probably more than one would care to think about.
Exactly. No, it's been a very enlightening discussion around the whole subject, not only the US, but broader than that, Danielle. I love your knowledge around all of the subjects in this regard. I feel like we've still only just scratched the surface, but for those of you listening today that are really lighting up to the massive opportunity that still and continues to exist in the US, and it will continue to be the engine of growth in the country in the changing and disruptive times that are ahead. Make sure you grab a copy of Shareclicity too. Now, I just want to transition into the quick four, the old bushfire lightning round questions that I ask of all of the guests. And I know you've answered some of these before, so I'll be looking for a slightly different response this time around, Danielle. So to kick that off, what's another favourite quote of yours and why?
Never say never. I think I might be a bit jaded and a bit cynical, but never say never. I think that's really when it comes to investing. Don't be too fearful, but also be alert. What's the expression? Alert but not alarmed. Expect the worst but prepare for the best, and that's kind of how I invest.
Yeah. That expression, expect the worst and then plan for the worst and expect the best, is exactly the way I play as well.
That's the one. Sorry, that was the one.
That's exactly the one. No, I'm right with you there. What about, apart from your books, what's a current top book that you would recommend people read and why?
I would love to say I have read it, but I've been just a little bit busy lately. But I think I've just had so much positive feedback about Morgan Housel's The Psychology of Money. And I think for a more holistic approach to our relationship with money and investing, I'm led to believe that is the go-to book. So that is on my summer reading list once the house is renovated.
Brilliant, yes, and you were sharing with me the challenges that before we got on air. I haven't read that book yet either, and that's certainly on my Kindle list. So The Psychology of Money, that's a cracker. Now, again, last time you shared some great advice with us, but and as well today, but what's the best piece of investment advice that you'd give someone today?
Just keep investing in yourself. Never stop learning. It's probably what I said last time, but I just think one should really just always try and retain that wonderful curiosity that kids have, that they love to keep learning. And I think as we get older, it's one of the reasons why I like to do the books and like to have to go to my son, help me with this, and he just calls me a boomer, and I go, whatever. I had an IT department, darling, when I worked. But I think that the secret to being young is obviously not necessarily the physical, but you can be young in spirit and you can be young of mind. And I always think we should all keep on learning.
Totally agree. I'll be learning until the day they nail me into a box, Danielle.
Warren Buffett is a great example. He'd probably shrivel up and die if he couldn't get in his old jalopy and go into the office each day. And whilst his investment style mightn't have changed that much, you never see somebody like him saying, I want to retire at 40.
Exactly right. Last question on the set. What's another personal habit that you believe has contributed most to your investment success?
That's a really good question. I've really had to get over the fear factor and believe in my decision making. And to be a good investor, you have to understand oneself very well. You have to understand your weaknesses, where your temptations are, where your biases are, and getting to know myself better has made me a better investor. I tend to be very progressive, very ahead of the curve, and sometimes one has to realise that not everybody thinks that way. So I might be right in 2 years, but not now.
Yes, the Nostradamus of the investment game right there, Danielle. Danielle, the final question then, just to sort of wrap it up. If you were talking to someone looking to invest to secure their long-term financial future over the next 15 to 20 years, what and how would you suggest they invest now and why?
That's a big question. Which asset classes are we covering?
Well, let's cover your favourite topic if we're talking the equities side of the equation.
Oh, well, obviously I would say, based on that I think you want to, it's not a binary decision. You have all Australian shares, you have all US shares. I think you have to have exposure to both. Nobody knows what's going to happen in 10, 20, 30 years. It's going to be very much changing. But I think now that we all have the opportunity to invest overseas, if you are younger, I think it would be a shame not to be a part of what is going to be happening over there, because unfortunately our economy, well, it's not a criticism of Australia. It's a large continent, but it's got a small population. It's dominated by homes and holes, mining and housing and property development. And whilst we have some great success stories like Atlassian and the like of Afterpay, which a lot of people didn't understand, by the way, and got that one wrong, really, if I just say to people, look at every product you interface with every day. I'm sitting here with a MacBook Air, with my iPhone, with my Blue Origin or whatever it's called microphone. I've used Google, I use Microsoft. I would love to have a Tesla. I'm saving up for one of those. But the point is that sadly, we don't interface with all the products that we use every day that they're made not here, or the innovation that has created them is not an Australian success story. Parts of them are. And I guess I'm saying to people that I really think that to have a balanced, diversified portfolio, you really want exposure, particularly to the US, and maybe selectively a few other stocks outside of the US.
Yeah, no, very well brought together. I always enjoy chatting all things investment with you, Danielle. You've shared a lot of gold with us today. Again, encourage the listeners to go out and grab a copy of Shareclicity too. It gives them everything they need, whether they're a intro investor or an experienced investor, to really get some gold on the US opportunity. So really appreciate you spending time with us today.
Thank you, Bushy. It's been a lovely chat.
Always. Talk again soon. Thanks, Danielle.
Thank you.
Cheers. Bye.
To get a summary of all this investment gold in the show notes, just email me on hello@khgroup.com.au. That's hello@khgroup.com.au. Or check us out at www.bushymartin.com.au/get-invested. I look forward to joining you next week for another episode of the Get Invested podcast. So thanks for listening, and as always, dream as if you'll live forever and live as if you'll die